Welcome, future investors and curious minds. Today we're delving into the investment wisdom of Warren Buffett, often hailed as the greatest investor of all time. Picture this, transforming a humble $1,000 into a staggering $30 million. Sounds fantastical, right? Yet this is exactly what Buffett accomplished for those who had faith in Berkshire Hathaway from the get-go. So how did he do it? What's the secret sauce behind his investment prowess? These are the questions we're setting out to answer as we explore the 7 fundamental rules that Buffett swears by. Rules that you too can incorporate into your investment strategy. So, whether you're an experienced investor or just dipping your toes into the vast ocean of investment, buckle up, because we're about to take a deep dive into the world of Warren Buffett's investment strategies. Today, we unravel the 7 foundational rules Buffett follows, rules that you can apply to your own investment journey. Let's dive in. Buffett's first rule is simple yet profound. Invest in what you understand. This rule may seem straightforward, but it's often overlooked in the rush to chase high returns. The stock market can be a complex and unpredictable beast. Investing in industries and companies that you're familiar with provides a level of insight that can be a significant advantage. Imagine trying to navigate a maze in the dark. Now imagine doing it with a torch. That's the difference between investing in what you don't know versus investing in what you do know. You're not just throwing your money into the wind and hoping for the best. You're making calculated decisions based on your understanding of a specific industry or company. Warren Buffett himself has passed on numerous investment opportunities because they fell outside of his circle of competence. He believes that focusing on what you know can help you identify the greatest opportunities and, equally important, avoid potential disasters. But what if your circle of competence seems too small? Well, the good news is that it can be expanded through learning and experience. So, don't be discouraged. Keep learning, keep growing, and keep investing in what you know. Remember, the aim is not to invest in every successful company, but to invest successfully in a few companies. This principle not only minimizes risk, but also empowers you to make informed decisions in turbulent markets. Buffett distinguishes between a stock's price and its value. What does this mean? Well, price is what you shell out when you buy a stock. It's that number that keeps fluctuating on the stock ticker. On the other hand, value is what the company is actually worth. It's determined by the company's fundamentals, such as its earnings, assets, and cash flow. Now, why is this distinction important? It's because the stock market doesn't always price a company accurately. Sometimes, a company's stock price might be lower than its actual value. This usually happens when the market overlooks or misunderstands the company's potential. In other situations, the stock price might be higher than the company's actual value, often driven by over-optimistic expectations. Buffett's strategy is to find companies that are undervalued by the market, but have strong fundamentals and promising growth prospects. He meticulously analyzes a company's financial health, competitive position, and the quality of its management. And if he believes that the company's stock price is lower than its intrinsic value, he considers it a good investment. But here's the catch. Once Buffett invests in an undervalued company, he doesn't immediately expect the market to correct its mistake. He's prepared to wait, often for years, for the market to recognize the company's true value. This patience, coupled with his ability to identify undervalued opportunities, has been a cornerstone of his success. A moat refers to a company's competitive advantage that protects it from competitors, much like a moat around a castle. This is the heart of Warren Buffett's third investment rule, the moat concept. It's an analogy that vividly depicts how some businesses have unique attributes that shield them against rivals, making them more resilient and profitable over the long haul. Think of the moat as a protective barrier. The wider and deeper it is, the harder it is for competitors to breach. This barrier could take many forms. It might be a strong brand identity that resonates with consumers, like that of Coca-Cola or Apple. It could be proprietary technology that gives a company an edge, like Google's search algorithms. It could even be regulatory licenses that limit competition, as is the case in the utilities or telecom sectors. Buffett focuses on these moat companies because they have a defendable position in their industry. They can maintain their edge and fend off competition, ensuring their profitability doesn't erode over time. This makes them less risky and more attractive for long-term investment. But it's not just about identifying these moat companies. It's also about assessing the durability of their moats. Buffett is on the lookout for businesses that are not only strong today, but have the potential to keep their competitive advantage for years to come. These advantages ensure long-term profitability and stability, critical factors in Buffett's investment choices. The moat concept is a cornerstone of Buffett's strategy, a testament to his forward-thinking approach to investing. Where others see market volatility as a risk, Buffett sees opportunity. This rule is all about perspective. Market fluctuations are a natural part of the investment landscape. They're like the ebb and flow of the tide, unpredictable yet inevitable. But instead of being daunted by these shifts, Buffett embraces them. He views market downturns as an open invitation to buy quality stocks at discounted prices. Think of it as a sale at your favorite store. When prices drop, it's an excellent opportunity to buy more of what you love. In the same vein, when the market takes a dip, it's an opportune time to invest in high-quality businesses that have become temporarily undervalued. But this approach requires a certain level of courage and conviction. It's easy to be swayed by the fear and uncertainty that often accompany market downturns. It's far more challenging to maintain your composure and stick to your investment principles. Yet, it's precisely in these moments of market panic that the greatest opportunities can be found. Buffett's rule here is reminiscent of the age-old adage, buy low, sell high. But it's more than just a catchy phrase. It's a fundamental strategy for making the most of market fluctuations. This rule is a reminder that in the world of investing, patience, perspective, and a bit of daring can go a long way. Fear can drive the market to irrational lows, presenting lucrative opportunities for those prepared to act counter to prevailing sentiments. Buffett's approach is epitomized by long-term investment. When it comes to holding onto stocks, he famously declared, "Our favorite holding period is forever." This statement encapsulates a cornerstone of Buffett's investment philosophy, and it's not just about dogged persistence. Rather, it's about reaping the fruits of a patient, long-term investment strategy. By holding onto stocks indefinitely, investors are positioned to benefit from the magic of compound interest. As interest accumulates, it begins to earn interest on itself, a snowball effect that can lead to significant wealth over time. Additionally, long-term investments typically yield dividends, providing a steady stream of income that can further boost an investor's earnings. Moreover, this approach promotes stability and reduces the risk associated with frequent trading and market speculation. It allows investors to ride out market fluctuations and focus on the long-term growth of their investments. So, the next time you're tempted to sell, remember Buffett's words, "Our favorite holding period is forever." By holding on to stocks indefinitely, investors can reap the benefits of compound interest, dividends, and long-term growth, avoiding the pitfalls of constant trading and speculation. Buffett emphasizes the power of compound interest, which he considers a fundamental principle of investing. Now let's unravel the magic of compound interest, often referred to as the eighth wonder of the world. Compound interest is like a snowball rolling down a hill. It starts small, but as it rolls further, it accumulates more snow, growing larger and faster. When you invest your money, you earn interest on the initial amount. But the beauty of compound interest is that you also earn interest on the interest, and this process repeats, creating a cycle of growing returns. This is why Warren Buffett, the Oracle of Omaha, has been such a staunch advocate of long-term investing. The longer you hold an investment, the more time you give your interest to compound, leading to exponential growth. Reinvesting dividends and holding stocks for long periods allows earnings to generate their own earnings, a concept that has significantly contributed to Buffett's wealth and that of Berkshire Hathaway's shareholders. Lastly, Buffett believes that integrity is non-negotiable. This rule is a cornerstone in Warren Buffett's investment philosophy, a guiding principle that underscores every decision he makes. Buffett holds that when assessing a company or a potential hire, three qualities matter: intelligence, energy, and most importantly, integrity. He often quips, "If they don't have the last one, the first two will kill you." Why is integrity so critical? It's because integrity ensures the sustainability of success. It's the ethical compass that guides actions, decisions, and interactions. In the world of business and investment, integrity translates into trustworthiness, transparency, and fair play. It's about honoring commitments, being accountable, and doing the right thing even when no one is watching. Buffett's focus on integrity doesn't just make good ethical sense, it makes good business sense too. Companies that prioritize integrity tend to foster long-term relationships, enjoy customer loyalty, and build strong reputations. This rule transcends investing, reminding us that ethical considerations should guide our financial decisions, ensuring not only profitability, but also peace of mind and societal benefit. In wrapping up, Warren Buffett's 7 rules of investing are insightful and time-tested. They distill decades of experience into a roadmap for successful investing. Starting with the principle of investing in what you know, Buffett emphasizes the importance of knowledge and understanding in making investment decisions. He then differentiates between price and value, teaching us to identify undervalued opportunities. The concept of the moat underscores the importance of a company's competitive advantage, while viewing market fluctuations as opportunities encourages a counterintuitive approach to investing. Buffett's long-term perspective, embodied in his forever holding period, redefines our perception of time in investing. The magic of compound interest, Buffett's 8th wonder of the world, is a potent tool in wealth accumulation. Lastly, the principle of integrity underscores the importance of ethical considerations in investing. By understanding and applying these principles, you too can turn small investments into substantial wealth. Until next time, keep investing. If you like this video, click the like button, comment, share with others, subscribe for more, and turn on post notifications so that you are notified when we post.